Welcome back to Market on Close. I'm Sam Bartis, live from the floor of the New York Stock Exchange. It's time now for Overlooked Stocks. Shares of Appian have rallied over 50% so far. This coming after the company reported earnings last week. Today it announced some new AI capabilities as well, which sent the stock to more than 2-year highs. So I'm joined by Tsilis to get us across this one, Senior Markets Correspondent. What are you seeing as far as the earnings and the reaction in the stock today of Appian, George?
Yeah, so if you look at the stock, I mean, you're right. In the last 5 trading sessions, the stock has effectively gone up about 50%. So it begs the question of what's going on. I'll explain my thoughts in just a sec. But for those who may not know, and this is a small company, a market cap of around $3 billion. It's essentially a application software company. They design software to automate processes like things like data mining, optimize business analytics, and decision analytics. But one of the other features about software, which I think is unique versus some of the larger competitors in this space, include the abilities to rapidly assist in deploying and designing and building and maintaining applications across the enterprise stack. And it's more of a application design software that allows more of a point and click versus a coding software, which is actually more user friendly. I think if you look in this space, some of the larger players include Atlassian, Simple Team, Salesforce, Workday, Tenenbaum, which is basically 10B. All these names are actually down in the last year, and as of late, Appian is actually now positive for the year, only up about 12%. But again, as you mentioned, in the last 6 trading sessions, up 50%. And if you look at what they reported in terms of their EPS and sales, it was actually quite meaningful considering that they came in with a 32-cent adjusted profit for the quarter. But they were only estimating around 5 cents, so that was a significant beat, and effectively doubled their adjusted EPS from 15 cents in the previous year. Sales also came in higher than estimated at 187 million, only up about 12 million versus the estimate, and that was higher by 20%. But it wasn't necessarily, I suggest, perhaps a one-time gain that the company generated, because they essentially denoted that going forward, they see cloud subscription revenue increasing at 19% and total revenue adjustments higher from around 698 at the midpoint to 715 million. But at the same time, the adjusted EPS for the full year moved from 33 cents to 52 cents. So if you just do the math, roughly speaking, that's about a 60 to 70% difference in what was anticipated in EPS for the year versus what they adjusted for. And that's essentially what we're seeing in price. It's catching up to the surprise adjustment in earnings for the fiscal year. And therefore, some of the analysts are still, I think, got caught off guard. If you look at Morgan Stanley, they increased their target from $29 to $45, and Barclays also has now the street low on the name at $37.
Just looking across that, and I mean, as far as the year-to-date performance, I mean, it's been trading pretty sideways, you could say, before this sort of big move that we've seen in November. I mean, can you speak to some of that? Because I understand it's been, a bit of a tough old year for some of those in the software business. But I also, as far as you mentioned, some of the analysts where they sit on it, I mean, it looks a little bit mixed. I mean, I do see some are in the sort of underperform camp. There are in a strong buy as well, but most of them are sort of sitting on the fence here.
So it's a good question. Looking across the board, and that's the reason I brought up some of the bigger players like Workday and Salesforce. You can even throw in Adobe in that camp. These companies actually have not performed very well at all, and they're major players in the software application space. So I think what's happening in the software space right now is that they're taking a back seat contingent upon what's going on in the hardware investment space for artificial intelligence. So I think the software application space, in terms of how they integrate AI, compete with AI, is still to be said, and that's why we're seeing the underperformance in that group. I think for Appian in particular, if you consider the market cap, which was low, I think sometimes these stocks are sleepers. In other words, the analysts don't adjust and look at them very closely, only on a quarter-to-quarter basis. The surprise was quite a surprise, I suggest. But at the same time, it makes a difference, especially when you talk about the adjustment in EPS guidance as well as the beat for the full fiscal year. It changes the entire model structure for the price expectation evaluation. And it's also more important here because if you look at the gross margins for Appian, It's 76% of sales. It's pretty much in line with some of those other major competitors, but net income margin in the last year was negative 1%. So effectively last year on about $690 million in sales, they lost $7 million. That's not the case for some of the major players I mentioned, like Adobe or CRM. They're profitable. So my point is that many times that you see these big moves, they come about when stocks are near GAAP profitability, which is the case for Appian, and then they have a breakthrough quarter. And I think that's what's happened here and why the stock has really posted some nice gains, at least on a percentage basis, since the earnings report on the 6th of November.
Yep, Appian sitting up 3.5% on the trading day today. Thanks so much for getting us across that name for us today, George Tsilis.